Hey everybody, and welcome in today's episode. We are going to talk about whether you should invest in international funds. This is a very important topic if you want to be globally diversified investor and if you want to basically reduce your risk by introducing exposure to international funds. However, the topic is debatable. The experts do disagree. So I would like to break it down for you to help you decide what you should do with your investment portfolio and whether you should invest in international funds. Now, this episode is really focused around if you're a US person, US investor, investing primarily in the US stock market. I'll have a separate episode that's geared towards people that live outside of the US and that invest in other markets. So for them, investing in international funds means something totally different. But I'll leave that episode as a part 2 of this particular topic. So coming back to if you're a US investor, if you're a US person making a salary in the US, and obviously you are investing in the US stock market, either through your 401k or a brokerage account, the dilemma is whether you should invest into international funds or you should only consider keeping your portfolio and limit it to the US stock market. Now, there is a debate about this topic, and it has a couple of flavors. One, whether you should own in the first place international funds, and two, if you are to own international funds, what should be that percentage? Let's tackle both of those questions and let's try to give arguments that would allow us to come up with a good argument and a proper decision for such an exposure. Now, if you're a US person, you earn your salary, you make your living in the US, the US stock market represents the biggest capitalization in the world, then what is the argument for you to own international funds? Should you do it? Should you not? And let me give you why experts disagree. Let me give you a couple of examples. If we take Jack Bogle, for example, the founder of Vanguard, the grandfather of the index fund, he would say his position has been that you don't need to own international funds if you own the total US stock market, because the companies that you own as part of the US stock market are actually big companies, they're global companies, they actually make money outside of the US as well. So holding those big, large companies automatically gives you exposure to international income. Let's not forget, most of the global companies, they are represented in Asia, in Europe, in Latin America, all over the world. They are making a certain part of their income by leveraging foreign markets and foreign investments. And that is a valid argument. Jack Bogle, who am I to dispute his vision and his guidance, obviously, right? It seems totally reasonable that it's sufficient to hold the large US companies, and that gives you enough exposure of international companies. Now, on the flip side, other experts, for example, Rick Ferry, Paul Merriman, other people that are well established in the investing community as experts and people who give advice to properly invest globally, they say that you should definitely have international funds in your portfolio. What does that mean for you as a US investor? It means that it's not enough to hold the S&P 500. It's not enough to hold the total stock market, because from a global perspective, the global market capitalization, the US represents roughly about 55%, give or take a few. That varies with time. So if the US represents about 55%, then what about the rest of the market cap, the rest of the 45%? That's basically, it's coming from all other countries in the rest of the world. So it's only logical that you should have some exposure to international funds, right? And I agree. That's totally logical. Again, I'm not disagreeing with Jack Bogle. I'm not disagreeing with Rick Ferry, with Paul Merriman, with all the other experts. They're also right. And let me give you another aspect to that discussion. If we establish that we need to have international exposure because the global market cap basically attributes about 45% to the rest of the world, then comes the other question. That is, how much of international funds should you hold? Again, going back to the premise that if holding total US stock market or S&P 500 gives you some exposure to international funds, then buying additionally international funds, is that anywhere in the realm of 20%, 25%? Is that enough? Does that comprise the 45% of global exposure you want to add to your US exposure? It's hard to say, but what experts will tell you is that you should hold international funds anywhere between 20 to 25%, 40%, some even say 50%. Paul Merriman, for example, he's always been a big advocate for holding 50% US and 50% international. And his argument is that he doesn't know, he can't predict the future. By the way, nobody can predict the future. So a safe thing to do is to have exposure to both the US and international at equal parts. That's one way to look at it. And it's a valid approach. It does make sense. At the very least, holding the global market cap, 55 US, 45 international, definitely does make sense. What I'd like to pose to you also as one more consideration, what percentage you should have as international funds, is the fact that are you okay with maybe slightly lower sort of income that you can get out of the international funds? Fact of the matter is, the US market historically has done better than the rest of the world. So if you're all in with US stocks, chances are you will be making, for the most part, a little bit higher than investing in international. So adding international, a percentage of 50% or 45% or even 25%, technically what that's going to do at first glance, it's going to reduce a little bit your return rate. But let's not forget, it may reduce a little bit your return rate, but that could be only for a certain period of time. If we look back, way back in 2008, 2009 crisis, what happened was the US market went down very fast, and the people who invested in international stocks, they felt that pain of their portfolio going down a little bit slower because they were more diversified. They hold international funds. The internationals, they didn't go down as drastically, at least at first. So their portfolio went down a little bit less, and thus they did a little bit better for a few years than the people who are all in the US market. So that's one side of the coin. The other side of the coin is that, yes, it can weather some of those harder times and bear markets, but in the long run, internationals have made less than US. So are you okay if that trend still continues? To kind of like sum it up, because I want to keep this episode fairly short, we have basically experts and expert guidance that says, no, we don't need to buy international funds because holding all the big US companies gives you enough of international exposure. That's one kind of school of thought, let's put it this way. Then on the other side, we have the guidance that we should own definitely international funds because looking at global market cap, we've got about 45% of the market cap represented by foreign companies. And it's ultimately a decision is up to you whether you should own international stocks and how much and to what extent. My personal opinion is that we should definitely own a little bit of international funds, maybe at the very least 20%, maybe up to 45%, because I don't want to worry about what's going to happen in the future. To me, yes, the US market is superior. It has given better returns than internationals, but that has been the situation thus far on average. Who knows, in the next 10, 15, 20, 40 years, things can change. Maybe internationals will do better than US. And I don't want to have to guess. All I want to do is I want to be diversified. I want to spread my risk. I don't want to bet on the US only. So I'm okay to maybe have less kind of a return rate if I invest in international for now, because maybe in the future it will even itself out and it will give me a peace of mind that I'm not putting all my eggs into one basket. That is only one dominant stock market. Another thing I'll just mention as a closing is that we should always think about what we can learn from history and prepare for the worst in the future. One example that is often mentioned with regards to this whole notion of having a home country bias, and that's the notion that if you live in the US, naturally you like to invest in the US and maybe you want to disregard the rest of the world, is because you've got this home country bias. That could be a trap, because the example that is often given is that a country like Japan, way back, I believe in the 80s, I'm not too sure, all the Japanese people, they had that home country bias. So the economy was booming, the Japanese market was, phenomenal, giving phenomenal returns. So Japanese people, they invested all into the Japanese market. However, things turned around, country was not doing so well, and the people who were all in on the Japanese market, they pretty much lost the majority of their investments. They had major losses, and it was really hard to recover. Most likely this will not happen with the US. However, things like that have happened in the past. A whole country having a home country bias has been penalizing investors in the past. So my advice to you is think about it this way. Do you want a little bit of extra protection, extra diversification? If yes, then by all means consider investing in international funds. So to wrap it up, in this episode we talked about, if you're a US investor, what you should do or what are the considerations for international funds. I'll have a separate episode released right after this one for people who are not investing in the US market or who live in other parts of the world and they may have their own country bias. Let's say if you live in Australia, you may want to invest the majority of your money in the Australian market or in the Asian market. Be on the lookout for this part 2 of this topic that's geared towards other global investors. Until then, I'll talk to you in the next one.